This week, we're going to have a look at the latest update from the IMF. We'll also have a look at the latest inflation numbers that have come through from a range of countries, China in particular. We'll also have a look at the importance of oil for US consumption, and we'll have a look at some pretty good retail sales numbers that are coming out for SA. We're going to start off with the IMF. Last week, the IMF published the latest update of its World Economic Outlook, and they upgraded their growth forecast for this year to 3.2%. And that was due to a wide range of countries. Most of the countries that we track saw an upgrade to growth. Despite the IMF's somber tone, and they were concerned about the potential for a slowdown, they actually did upgrade their growth forecast for this year. For next year, they're looking at about 3.1% for the globe. That's slightly ahead of consensus, but I think the key point out of this is that the IMF expects around 3% growth for next year for the globe. The consensus forecast at the moment is around 3% for the globe. Pretty much wherever you look, the current expectation is that global growth next year is going to be around 3%. And 3% is a pretty good number. It's in line with the 45-year average. And if you look at IMF forecasts for subsequent years, there's a very mild deterioration, but it stays at and around that sort of level. So based on current growth forecasts from IMF and consensus, there's little reason to be concerned around global growth over the coming few years. Switching to inflation, we've now had inflation prints for 39 of the 50 largest economies. And some good news on this front, global inflation ticked down. The median across all of those countries is now at 2.5%. Last month it was 2.7%. So an encouraging reading. Of course, we haven't had the US CPI number yet. It's been delayed due to the shutdown. That number should come out this week. Very interesting. The current consensus forecast is that US inflation is expected to increase from 2.9 to 3.1. So we're going to be in a situation where US inflation is just north of 3%, while global inflation is 2.5%. And typically over time, US inflation and global inflation have been very similar numbers. We're starting to pick up a divergence, which just highlights a difficult situation that the Fed faces. The US has got US-specific inflation problems at the moment, which again makes it difficult for the Fed. The market expects 4 rate cuts over the coming year. Given that US inflation is picking up relative to the rest of the globe, that probably seems a bit optimistic. Switching to Chinese inflation came out at minus 0.3%. Still below zero, and PPI inflation is below 0.2. And that does suggest that there is still ample scope for further stimulus from the Chinese authorities. They wouldn't want inflation expectations to become entrenched at too low a level. It will affect consumer spend. If consumers expect inflation to be negative, they'll simply defer purchases. So we can expect some announcements from the Chinese authorities to attempt to get inflation and inflation expectations up. In the interim, it's worth keeping an eye on the leading indicators for the Chinese economy. And both of the ones that we look at suggest that there's likely to be a bit of a soft patch coming. Now, this is the first month in many months that this indicator has suggested caution. So perhaps we just need to wait another month or so just to see if it's confirmed or not. But it is nonetheless a bit concerning that post what has been quite a strong patch of Chinese economic growth, and we'll touch on that shortly, the latest credit numbers suggest that the Chinese economy may be due a bit of a slowdown. And the latest Chinese numbers actually did come out this morning. So while there might be a slowdown to come, the current numbers are very strong. Chinese economic activity grew at 4.8%. That was above the consensus forecast of 4.7%. It was a lower growth rate than the quarter before, but still we'll take the second largest economy growing at 4.8% any day. And it was encouraging that it did surprise on the upside. The problem for China is that nominal GDP growth is currently still quite low, sitting at 3.7%. And you grow your way out of a debt problem with a combination of lower interest rates and higher nominal GDP. So I think it might be a concern for the Chinese authorities that nominal GDP growth is as low as it is. And again, that provides further reason for an attempt to try and stimulate the economy. Just incidentally, we have seen a surge in imports in China, which does suggest that there is an uptick in domestic demand. And that's just something we'll have to keep an eye on in contrast against this leading indicator, which is flagging some caution. Switching to oil, we've seen some encouraging developments in oil over the past couple of years. There's been a sizable decline. Oil at the moment is trading at $60 per barrel, just a bit north of that, which is roughly in line with where it was 20 years ago. Quite incredible. Over the last couple of years, we've seen a sizable decline. The oil price at the moment is about half of where it was in May 2022. The 6-month average is down 35% relative to where it was in May 2022. And if we do the maths, fuel is a large part of consumption expenditure, typically about 4% across developed markets. The decline in oil would have given consumers an extra somewhere around 40 to 50 bips per annum to either spend on other things or to save. And I think that goes a long way in explaining why US consumption expenditure has been so strong over the past couple of years. If we go back to May 2022 and we look at forecasts for consumption expenditure in the US from the Congressional Budget Office, the current numbers are about 20 basis points per annum above the forecast back then. But the boost to consumption, assuming that consumers would have spent the savings they got from lower fuel prices on other things, the boost to consumption would have been 40 to 50 bips. So more than all of the surprising resilience of the US consumer over the past couple of years is simply due to lower fuel prices, which is an important point. It means from our purposes, we need to keep a very close eye on fuel prices. And should it be the case we see an increase, we'll have to revise some of the very strong forecasts for growth in the US and across the globe that we referenced at the beginning of the presentation. Switching to South Africa, we've had the SACCI business confidence numbers come out last week, and they're quite encouraging. We can see that there's been a quite sizable uptick in economic activity, which is what this series measures over the past couple of months. And the series does correlate with the BER business confidence survey. So hopefully when that series comes out, we'll also see an uptick. And business confidence is the key leading indicator for private sector job creation. It's looking like we're starting to see a positive story developing both on the growth front and potentially in the employment front in SA over the coming 12 months, should it be the case that business confidence remains elevated. We've noted before that business confidence in South Africa is pretty strongly correlated with our SOE index. So the improvement in business confidence, I suspect, is likely to be linked to the improvements that we've seen at South African SOEs. And on retail sales in SA, the latest print showed a slowdown in volume growth in August. The month-to-month numbers are quite volatile, but what it showed is that year-on-year real retail sales growth slowed from over 5% down to 2%. But it's important to note that the year-to-date growth has actually been pretty strong, one of the strongest that we've seen in the last decade or so. And I think what we're seeing play out is the typical cycle for SA. We see stronger commodity prices that leads to some rand strength that allows the SARB to cut, and that in turn sees consumption picking up. So as long as Chinese growth remains strong and we continue to see support for global commodity prices, we would expect that to translate into further support for SA Inc. And that's where we're going to leave it for this week.